Welcome to our presentation, Strategies for Banks of Under $1 Billion in Assets. This is a presentation that we presented at the 2012 Acquire or Be Acquired conference. But really the topic came from results and comments from the 2011 conference. We were coming off the Dodd-Frank Act and there were many predictions about where the industry was headed. And many experts at that conference predicted that banks needed to be over $1 billion in order to survive and prosper in the industry. The remarks and the feedback from those comments were pretty wide-ranging, from fear to concern to outright being upset about the comments that were being made. And so we discussed the possibility of presenting case studies of successful banks that were under $1 billion and some of the strategies that were being implemented. And so today what we're going to do is we are going to go over 6 case studies of banks that have implemented wide-ranging strategies. But before we get to those, I want to at least address this idea of the size within the industry and whether or not big banks do have a competitive advantage. And let's first start with some data reflecting publicly traded bank information. Of over the 1,000 institutions that are traded publicly, about 70% of them are under $1 billion in assets. And as you look at this information, you will see that there is certainly a wide disparity in performance and asset quality that has led to the most important piece of data, which is banks of under $1 billion in assets are now trading at roughly half of what banks of over $10 billion are trading at. And that creates a huge competitive disadvantage related to raising capital, to M&A transactions, and to shareholder satisfaction. So we're going to talk a little bit about why that is. And certainly one of the things is the ability of the larger banks to access capital markets. Capital has clearly been a key ingredient for the industry in the last few years. And the larger banks have had access to capital markets and been able to clean up balance sheets and been able to achieve higher performance as a result. Smaller community banks have only been able to manage their way out of it, not being able to access the capital markets, and has resulted in a delay or deferment of some of their levels of profitability. So this is some headwinds that we're facing within the community bank environment. And so as we look at the whole community bank model, we're operating at lower levels of profitability, we're operating at deep discounts to book value, our revenue growth is slow. Larger banks have implemented strategies to address these, whether it be capital raising, cleansing of balance sheets, staff and workforce layoffs. But community banks, for the most part, have continued to operate as is. And that's one of the things that we're going to challenge you today as we look through these case studies, is what changes can you make in your strategy to get back to the levels of profitability you need to be at to provide shareholder value.
I've got the first case study, which is a de novo bank that has lots of capital and it's looking to expand. It was established in 2007 and it's about a $250 million bank now. It is looking to acquire other institutions, and one within its market, which is about 5 miles away, is a very troubled bank. It has about $92 million in assets, and you can see from the chart, which I won't go over, how close the banks are. So Town & Country Bank, which is the target bank, experienced significant asset quality issues. It needs to raise capital. In an unassisted transaction, in other words, not a failed bank and a government assistance, the buyer needed to limit the risks from acquiring Town & Country's troubled bank portfolio. Town & Country had about $65 million in loans, of which $5.3 million were non-performing, and the buyer considered $15 million of the portfolio troubled. So how do you make this acquisition in such a way that you protect yourself as the buyer from the troubled and non-performing assets? The seller didn't have enough capital to withstand the troubled asset part of the transaction. So what happened was the seller holding company and the buyer holding company entered into an agreement whereby the buyer holding company gave interest, it's an LLC, to the seller holding company. The seller holding company then exchanged for the interest in the buyer, the bank, the troubled bank. So now we have the buyer owning two banks, and the seller holding company owns interests in the buyer. The buyer required that the selling holding company not distribute any of the securities exchanged for the bank stock. So what happened was they are going to work out the troubled loans over 2 years, and at the end of the 2-year period there will be a final settlement. If the losses from the date of acquisition exceed the gains from that period of time, then the buyer holding company will acquire back shares or LLC interests that it put in the holding company. The holding company will then take that cash and put it into the bank so it doesn't escape the buyer holding company. And then if there are any interests in the buyer left, those will be distributed to the shareholders of the seller. So we have a 2-year window. It ends in June of this year to see how many, if any, units of buyer the selling shareholders will receive.
Bob, a question for you. Obviously this transaction is not a failed bank deal, and it begs the question, isn't it easier to wait until the bank fails rather than buying a troubled institution, given all the complexities of what it took to put the deal together, or is there a good reason to do this kind of a structure with a troubled bank?
Well, I think that's a good question, and the failed bank market is now diminishing, the number of banks out there that are potentially going to fail. So this buyer decided not to wait until the bank failed because it had no guarantee that it would be the winning bidder. It liked the footprint, it liked where they were. They had overlapping customers, so just wanted to cement the deal.
I think this also demonstrates that you have to be creative in today's marketplace, and I know there's been some transactions that have been announced, like the Bank Atlantic BB&T deal, where the bank was sold out from underneath the holding company. TARP and sometimes trust preferred is involved. And how are those deals structured, and what advantages might that play in the future?
Well, it would take longer than we have right now to explain all those. We have a lot of transactions now where the buyers are just buying the assets and assuming the liabilities of the bank, not acquiring the stock. And the Bank Atlantic deal was one where the selling holding company had trust preferred securities. And under the terms of the trust preferred securities, if the selling holding company sold substantially all of its assets, it had to seek reapproval or approval of the trust preferred holders, the pool. And in addition to that, the buyer had to assume the trust preferreds. In the Bank Atlantic case, which was decided early this spring, the court held that under the terms of the documentation, there was really a sale of substantially all of the stock of the entity, notwithstanding the fact that that were just assets and liabilities. So BB&T, which was the buyer, went back and redid the deal and restructured, and I think they're going to close. But we have a lot of transactions right now that are non-traditional, where we're buying assets and having to liquidate the bank, the leftover bank, which brings into a quandary. Like yesterday, I was with the state. How do we liquidate the bank and it survived for 5 years as a liquidating entity? So you've got to be very creative in these instances, and I don't think there's going to be that many more failed banks.